So here we are now at the end of May. The war in Iran is not at all resolved, even though there are conflicting reports that suggest that it perhaps might have been in the not too distant future. We await a definitive resolution. And as a result, we have this ongoing question of, well, what will the market do? Everyone knows that stock markets have continued to hit new all-time highs. And so the answer that most people would think is, well, the market thinks the war is no big problem. And that's a defensible position if you look only at the stock market. But what about the bond market? Have you looked at that lately? Bonds trade based on what you expect to happen with inflation. And even though central bankers around the world have so far been tamping down inflation, have done nothing to raise rates at any point, even though there might be some inflationary pressure, the bond market nonetheless moves based on expected inflation. And as a result of that, over the past 4 or 5 weeks, interest rates on the long end of the curve have gone up by about 25 basis points. What that means is the stock market is anticipating things to be smooth, but the bond market is saying, well, wait a minute now, we're expecting some inflation. Now, to be clear, stocks can do perfectly well in an inflationary environment. But it does strike me as being a bit odd because we're now in a situation where we've got an incoming new chair to the Federal Reserve in the US who is going to be under some political pressure to lower rates. We have inflation numbers that are coming in hot on both sides of the border, and inflation has been steadily above 2%, which is the central bank target for both Canada and the US for the past 3.5 or 4 years, and has been rising. And it's now looking to actually go over 3%, which is the point where you might want to start taking some action and raising rates to keep inflation under control. We have the yield curve going up, and yet we have central banks saying, nope, nothing to see here. Everything is fine. And the stock market is saying everything is fine, and there's not a lot that needs to be done. We're going to be at a point in the not too distant future where we're going to find out which narrative, in fact, holds sway. Will stocks continue to go up indefinitely with inflation going higher? Or, as is often the case, but not always, will higher inflation cause stocks to start losing some of their luster? The opportunity cost is a factor that you have to consider. The risk-free rate, you can get more money by putting your money into treasury bills or GICs or under the mattress than you would if the rates were a little bit lower. So as the opportunity cost changes and as the opportunity to get a better return from bonds goes up, for interest-bearing interest products to go up, what will you do and what will the market do? It's an ongoing question that deserves to be answered and I believe will be answered before the end of June. So pay attention. If you're worried about the current investment climate in your money, go to my website to book a call for personalized advice to assist you in feeling secure and protected about your retirement.